I'm Owen Bigland. This is the Inside Edge video blog. This summer I have read probably at least a dozen articles, both in the United States as well as in Canadian publications, on this unprecedented bull run we've had in the S&P 500, the NASDAQ, the Dow, and to some extent the TSX. Right now, as I speak here, we're end of summer. In the August 22nd issue of the New York Times, there was a headline entitled, "We are now in the second longest bull run in history, but most Americans aren't at the party." Now, similar articles I have read multiple times this summer in the Wall Street Journal, the Globe and Mail, Barron's that I get every Saturday, have all written many articles. Just Google it. This bull market and how most Americans and most Canadians have not been sitting at the table. And essentially we are now 3,500 days into this bull market in the US, into the S&P 500, the second longest bull run in history. Prices on a basket of stock in the S&P 500 since early 2009 are up over 150%. So if you just would have bought the index, put $100 into the S&P 500, you're up over 250. Your balance now is up over $250, well over. So the crazy thing is, though, is that, and the same numbers are in Canada, only about 10% of Americans even have a brokerage account, and it would be about the same in Canada. Very few people have participated in this, both in the stock market or in the real estate bull market that we've experienced. The bull market for real estate in Vancouver here, we've experienced for 30 years. Sure, we've had a few dips on the road. But at least in Vancouver here, when it comes to real estate, 65% of people living in Vancouver own their principal residence. 20% of the population in Vancouver own multiple properties. They own an investment property. So they have created a tremendous amount of wealth. People wonder, where's the money coming from? How are people able to afford a $600,000 or $700,000 condo? Well, the answer is right there. These are people that, in Vancouver anyways, it's been an equity-driven market. I've blogged about this many times. It's people that have bought 20 and 30 years ago, or even 10 years ago, or 5 years ago, and stayed the course and held the property and continued to save their money, and then maybe bought themselves an investment property. There are also people that have been putting money into their TFSA, into TD Bank and Royal Bank and Johnson & Johnson and Apple shares and Pepsi and Merck and Amazon, whatever, and have been creating a tremendous amount of wealth over the last 10 or 15 years. This is where the money's coming from. But it's what I talk about in my book and what I've been trying to pound home to a lot of people here. You have to be in the market to benefit from the market, and how waiting on the sidelines, endlessly waiting for some magical big correction that's going to come, it's just around the corner, that's what everyone will tell you, but it never seems to appear. And when it does, it's not the 50 or 60 or 70% crash that these people are predicting. It's more like what I've seen over the last 30 or 35 years here, and what I've seen in the stock market. They're generally 5, 10, 15, 20% corrections, and they're usually pretty short-lived. They last 6 months to a year, and then somebody turns the lights back on, and off it goes again. So the message I'm trying to put forward here is an analogy that's used by a lot of hedge fund and private equity people as well. There's an old saying with private equity or hedge funds when it comes to buying a company: if you can't figure out a way to kill it, just buy it. And that's the way a lot of people have been with getting on board with Amazon over the last 5 or 6 years. Stock is up over 1,000%. So the message I'm trying to send here to people, especially if you're on the outside looking in, and what I find too is that most people that are on the outside looking in recognize the need to get in. The hard part, though, of course, is graduating those 2 classes that I blogged about a couple of weeks ago, getting your down payment funds together, and getting pre-approved for a mortgage. Once you can cross those 2 hurdles, now you're cooking. Now you're in the market. And you have to be comfortable with the fact that once you're in the market, it's not going to be a moonshot straight up. You have to get comfortable with some unknowns there, some volatility, some market corrections. That's the way markets work. You can't have it in a perfect world where you buy a stock or buy a condo and it goes up in a straight line for the next 25 years. That's not what participating in a market is. To get those incredible returns, you have to be disciplined and stay the course when that volatility hits. It's par for the course. If you don't want to take or can't handle being in a market like Vancouver Real Estate for the long term, or in the S&P 500 or the NASDAQ, then you're going to be relegated to interest-bearing vehicles. Things like term deposits, GICs, treasury bills, bonds. And on a side note, it's just so bad. I'll hear people talking about they've got a TFSA. Well, about 50% of Canadians have a TFSA. The problem is they don't know and have no clue what the TFSA is good for. Instead of putting in good dividend paying or good growth stocks for long-term investments where you can get an 8 or 10% annualized return, not every year, and there's going to be years when it's going to go down 10 or 15%, but over the next 20 or 30 years, you'll probably annualize about an 8 or 10% return. Instead, they put in term deposits and GICs into the TFSA, which is not investing. That's just parking money, and you're actually guaranteeing to lose money in a term deposit. You're losing money. Term deposit's only paying you 2%, and inflation's running at 2.5%. If you've got a term deposit outside of your TFSA, it's even worse. You're getting taxed on it at your full rate, and inflation's killing the rest on it. So you have to get your money to work for you. If you haven't read my book or bought my book, you should. I know many of you have. You have to get your money working for you. You have to invest it. And that doesn't mean putting in term deposits or GICs. It means putting it into good dividend-paying blue chip stocks and buying your principal residence as opposed to being a lifetime renter, which is nowhere in Vancouver, and staying the course and learning a little bit more about taxation and the Canadian dividend tax credit and TFSAs and how they will shelter the growth and you can pull it out tax-free. You need to learn this stuff. But these articles that I've read over the summer, it's shocking how few people have participated in this 150% bull run we've had in the US and Canada over the last 7 or 8 years here. Most people should be investing their money here, even if it's just $100 or $200 a month. Get started on it. You need to be getting your money working for you. I can't stress that enough. It's one of the main foundations of why I do this blog. I'm Owen Bigland. As always, thanks for watching. I'll see you next week.